everybody could take a second to fill out those pre-polling questions.
All right, can you see the first poll question on the screen?
Yep.
Okay. I'll give you about 20 more seconds and then I'll pull up the second one. Well, first I'll share the results and then I'll pull up the second one. All right, here are the first results. Have you begun PPP loan forgiveness application process? 24% said yes, I will use the 8-week covered period. 12% yes, I have began gathering information. And 29% no, I will use the 24-week covered period, and 41% NA. All right, the next poll question I'll pull up. One second. Let me pull up it actually. Let's see. There we go. Okay. Can you see the second poll?
We sure can.
Okay. Thank you. I'll give you guys another 30 seconds on these and then I'll share these results. Okay, and who at your hospital is responsible for staying current on funding and regulatory guidance? 29% CEO, 81% CFO, 10% compliance officer, and 24% other. Alrighty, and that wraps up the pre-polling questions. I'll hand it off to Eric now.
Sounds good. Appreciate it. Thank you to everyone who's on the call today, and we look forward to presenting some additional information. We did make some edits to the slide deck just yesterday as some additional recent guidance came out. So just want everybody to be assured we've got some top-notch folks that are really in the weeds on the regulations as they're coming out and working their best to interpret those and share that information with you. Again, kind of to Kate and Seneva's encouragement, we've got a lot of hospitals represented today. So if you've got some specific questions about your organization, we really encourage you to speak up, take yourself off of unmute or type it in the chat box. We'd like to have some dialogue today and some discussion with the group. So for the next slide, as we look about our topics that we want to work through today, we've got SBA PPP tracking and some other considerations. That is going to be led by Crystal Breach, who's a director in our Springfield, Missouri office. Crystal leads a team to provide tax services and compliance work for hospitals and community health centers all over the United States. So happy to have Crystal on today to lead us through the SBA PPP work. The next is business interruption. And this is something that's just totally out of my wheelhouse and knowledge base. But fortunately, we've got Julia Mast on the call today out of our Kansas City office. Julia is a director, and she works and focuses on forensics and other fraud and business valuation and litigation cases. And because of that heavy insurance assessment work, she's been closely following a lot of the business interruption claims that are coming out of the COVID situation. So happy to have her today. We've also got new provider relief funds, and this is one that's there's been some deadline changes and some new information come out on Medicaid CHIP and safety net hospitals. Derek Pierce is going to lead this. Derek Pierce is a partner in our Little Rock, Arkansas office, and I know that several of you probably know Derek. He's been the president of HFMA, and if you're in the South, most likely you know Derek. So happy to have him on talking about that. And then rounding out the last one, I know that a lot of people have been asking questions about how is this going to impact my cost report. That's a very important component of our organization. And so to talk about that, we've got one of our managing directors, Steve Party, that's down in our Houston, Texas office. And Steve has been in the industry for a number of years, worked out of Kansas City for quite a while, and he focuses on strategic, operational, and financial management with a keen interest in the cost report. So he's going to go over what does this mean for us for interim and other settlement processes in the cost report. So thank you to all the BKDers for being on the call today, for all the hospitals. We look forward to answering some of your questions today and having some additional follow-up if you need to talk in greater detail. So I'm going to go ahead and if we want to advance the next two slides, we're going to move into the SBA PPP, and I'll let Crystal Breach take it from there.
All right, thank you, Eric. So yeah, we're going to talk about the PPP loans, and not really going to get into, whether you can get one at this point. You've probably either got one or not. So I'm going to get into what everybody's talking about now, the forgiveness, and how to get that forgiveness and how to track all those loan proceeds. Next slide, please. So for PPP loan forgiveness, it's kind of been, there's been some changes since it was initially enacted back in March. In June, they made the Paycheck Protection Program Flexibility Act, which for the most part was pretty taxpayer friendly, actually. That is what extended the covered period to the 24 weeks. Now you can, as the polling question kind of alluded to, you can elect as early as 8 weeks, or they came out with some additional guidance as well to say, really you can do it anytime between that 8 week and 24 weeks. So we had a lot of people when they released that act that said, well, we don't really want to wait 24 whole weeks, but we can't really meet it in the 8. So, if you get to 12 weeks or something and you've used up the loan proceeds, you've met all the requirements that we'll go through, you can start that forgiveness application at any time to get that forgiveness taken care of. So that 24-week extension, it really had a huge change in how we were talking with clients, to where, before we were trying to figure out what's the best way to get the most periods in, because you've got the covered period, which is from the date you get your loan proceeds. And at that point was 8 weeks, or can be up to 24 weeks. Then you also have the alternative covered period. And so that's where you can kind of, really it's administratively a little bit easier. You can just wait till the next payroll period. So then you're just pulling payroll reports and you're not really pulling partial time periods. Prior to this act, we were having lots and lots of conversations about how we could get in some more to make sure we meet that 8 weeks. But now that's really kind of changed. I think a lot of people are able to meet that 24 weeks based on, how they applied for the PPP loans. So I see a lot of people still wanting to do the alternative covered period just because of that administrative ease. And that is where you start with that very next payroll period, and then you just go for the time period that you need. Now, with the alternative covered period, remember it's only available for payroll costs, and I'll get into the differences of the costs. But you could, if you have the alternative covered period, you could be using that period for your payroll and then be using the covered period for your other types of costs. So keep that in mind, that you can't use that alternative period for the other non-payroll costs. And it's costs paid and incurred. So that's still in there to where it's costs that actually are paid out. So it's actual paychecks distributed, it's actual bills paid, but it's also things that are incurred. So you get a little bit of leniency for, that last payroll period. If you don't pay it until after that time period that you're looking at, then you can still include it because it was incurred during that time. Next slide. So when we get into the costs themselves, you need to make sure you've got your eligible payroll costs, and then you've also got your non-payroll costs. So eligible payroll costs are, the normal type of payroll costs, any salaries and wages, but also health insurance, retirement, other types of benefits. We had a lot of conversations with clients in the beginning where they were trying to do maybe bonuses or hazard pay to make sure they could get to those amounts. And, that's still eligible. That's still part of your salaries and wages. One caveat there that came up in a lot of conversations is make sure if you're doing bonuses or hazard pay or anything like that, that you're not going to get any individual over that prorated $100,000 for the year. With the Flexibility Act, that was changed to be, it's about $46,000. So you could give bonuses to people, but you can't get them over that $46,000 for the full 24 weeks. Now, if you were going to do only the 8 weeks, it's significantly less. It's 8 out of 52 times 100,000, which was only about 15,000 that a certain individual could have. So keep that in mind with any of your bonuses or hazard pay, to make sure if you're paying that for the purpose of PPP loan forgiveness, you're going to get the benefit from it. So non-payroll costs, things like rent, mortgage payments, utilities, I think telephone's in there. So there's quite a few of different non-payroll costs that you can include. And again, consider that costs paid and incurred. It might be your utility bill is incurred during the period, but paid afterwards. And so you might be able to include that as well. But the non-payroll costs, like I said, have to use that covered period, not the alternative. So also keep that in mind. And remember that the Flexibility Act changed. Originally, the non-payroll costs couldn't be more than 25%. Your payroll costs had to be 75% of your use of the funds. That changed to 60%. So you can now, if you've got that, enough payroll and you want to use rent, mortgage payments, things like that, you can basically use up to 40% of that, of your loan proceeds towards those non-payroll costs. Next slide. So with the forgiveness, not only are we looking at the funds and how you're using them and the costs, we're looking also at the employee counts and your FTE employees. So you need to make sure that you're paying attention to that so that there's no reductions to your loan forgiveness. What they're really looking for here is that there's no more than a 25% reduction in your FTEs or in average salaries during the period that you choose, compared to either the first quarter of 2019, either the first quarter that was 215 to 615 of 2019 or the first quarter of this year. So there's some comparisons there and you can kind of, use that to manipulate. It seems like with most of our healthcare entities, they're not having too much trouble meeting that because they didn't have to get rid of too many people during the time, but make sure you're meeting those as well. If you're going to do less than that 24 weeks, make sure you're getting those FTE counts where they need to be. And the Flexibility Act had extended the FTE reduction deadline to December 31st. So originally it was June 30th. If you had more than 25% reduction, you had to get back to those levels that you needed by June 30th. Once this kind of continued on longer than I think they thought it would in March, that went into December 31st, which was again very taxpayer friendly. So you've got more time to get back to that if you need to. And there are some exceptions for those FTE restoration deadlines, which helps a lot of people as well. So, if you have people that just left voluntarily, you're not going to be penalized for that. You don't have to replace that person. There's also, if they were terminated for cause, you don't have to keep somebody on that you would otherwise be terminating, just so that you meet those FTE counts. Then there's also exceptions for people that maybe you laid them off, furloughed them, reduced their hours, but then you've offered for them to come back and they've decided they don't want to. So if you've given a written offer, but they declined that, that's also not going to penalize you. Now with that one, you need to make sure that if they, if they were laid off or something, that you followed the unemployment procedures for your state and were reported to unemployment to get that exception. And next. And the other things for the loan forgiveness, if you don't end up getting it all forgiven, which I hope that everybody can get it all forgiven, but I did want to briefly mention these. The loan matures 5 years for any portion that's not forgiven. So previously it was only 2 years and they extended that to 5. And it applies to any loans received after the enactment date of the new bill of the Flexibility Act, which was, I think, it was early June. So, but existing loans, if you had a loan before that, there's some modifications that can be made. So if you think you're not going to get forgiveness and you want that full 5 years, you can work with your bank to get that modification. And no principal and interest payments would be due until the SBA remits the forgiveness amount. So, if you don't think that you're going to get the forgiveness, I would say you want to go that full 24 weeks and then see what they're going to forgive. And then, that's going to delay those payments as long as possible. And the deadline for a forgiveness request is within 10 months of the covered period that you use. So that you've got 10 months from, maybe possibly 24 weeks, this could go on for quite a long time if you need to. Now, like I said, hopefully these provisions don't really apply to most of you and you can get it all forgiven, but keep these items in mind as well so you can get the best cash flow and interest payments and principal payments that you can. And the next slide. The last thing I wanted to touch on is kind of related to the PPP loans. This is the payroll tax deferral. And so this was you can defer the 6.2% FICA that you pay from March 27th through December 31st of this year. You defer it, you're just not paying it until 50% of it due December 31st, 2021, and then the rest of it December 31st, 2022. So it's a really long time. You've got FICA back from April of 2020 that you're not having to pay fully until December 31st, 2022. So that can really affect your cash flow. Of course, make sure you've got that to pay when those dates come around. But why this relates to the PPP loan is that previously they had said if you got the PPP loan, you couldn't do this. The Flexibility Act then came out and said, well, now you can. There's no real restrictions. So if you weren't doing this before, I would get with your payroll providers or your payroll department and start doing that. Most people that we've talked to are doing it if they can. There's, it's a little bit of an administrative tracking, but they've revised the 941 now so that it's tracking it. And it's just cash flow changes. So, why would you have to pay in if you don't have to? So make sure that if you weren't doing this before, talk with your payroll to see if you can get this figured out as well to start doing that. And the next slide. So now we want to have just a little bit of an open discussion. If there's any questions, we'll take those, but also we want to see how you're calculating or tracking PPP loan forgiveness. BKD has developed a tool that we'd be happy to, talk with you about if you don't have any way to track it or you haven't thought about that yet. It seemed like most people were at least thinking about it based on the polling question, but I'm curious to see what you guys are doing as far as calculating or tracking your forgiveness to make sure that you can get there.
All right, thank you, Crystal. We'll wait for a couple questions to come in on the chat box down at the bottom. But so if I'm a small hospital and the FICA, if I defer that for that long of a period, and I've kind of got to make a lump sum payment, is there any interest or anything associated with that? Or, I mean, it seems like a no-brainer for a lot of our hospitals that are struggling for, cash flow.
Right, yeah, there's no interest associated with it. Now, of course, if you don't pay it, once December 31st, 21 or 22 comes around, then they're gonna tack on some interest and things. But yeah, there's no payment. Now, I don't think that the IRS or anybody is going to be pushing you as a reminder. So the only caveat could be, if you don't think that you'll be able to track it or if you don't think you're gonna have the money then and you have the money now. But yeah, most of the people we're talking to, as soon as they found out they could do it, they've said, well, yeah, why wouldn't we? It's at least, it's more money we can keep right now to pay for things we might need. And then later we'll, true it up. So, and it's a long time period. Even if it's smaller amounts, even if you don't have huge amounts of employees that it would affect, it's still money that you don't have to pay in right now that I think makes people think it's a no-brainer.
Okay. Well, we'll still give some time for people to kind of think about that, mull that over and submit a question. But I do want to, in the sake of time, move on to our next topic. Senator, if you wouldn't mind to switch over to the business interruption and to turn it over to Ms. Julia to kind of walk us through her piece, please.
Okay, well, thank you for having me on today. It's good to be able to talk with you all. If you want to hit to the next slide, we're just going to dive right into it right now. So I've put this slide together and I've used this with multiple different healthcare calls throughout the pandemic to kind of go over and explain kind of what business interruption, lost business income is and what extra expense is. And so, this comes out of a litigation handbook that we use as forensic accountants, but I've kind of molded it into what, for these purposes. So really, when you're going along before the pandemic hit, that's the blue line you have here. And then obviously we had something crazy happen with the pandemic, and maybe some of you were caught in that, shut down everything that's not necessarily needs to be done, excuse me, and keep on your merry way. And so you probably were still servicing patients and things, through your emergency rooms and different things like that. But all the elective and stuff was out the door, delayed. The thing is you all well know that when you delay something, surgeons just don't have a bunch of extra time later on. And so delay is actually canceled, and that revenue is gone for the most part, because even if it's rescheduled, that bumps somebody else out, over time. So the red is basically when something's happened and there's a dip in your income, and then it starts to recover. The green line is just showing what you expected your projections to be. This looks pretty hockey stick in a way, but you know what your revenues were expecting to be. And so within that pink shaded area is kind of the business interruption loss. And I've spent a lot of time talking to all sorts of different healthcare agencies across the country about their experiences and looking at their insurance to see if their insurance covers this. And as you all probably have done in your own facilities, is pulled out and dusted off that old insurance policy that you have, that you renew every year and you don't think too much about until something like this happens. And a lot of the insurance policies that we had seen have a virus and bacteria exclusion. Some hospitals have a little bit different verbiage around that, but for the most part, there's an exclusion for virus and bacteria when it comes to a property loss. So this is a really good example of what happens when if one of your facilities or your main facility got hit by a tornado or got flooded or had a fire or something like that. And it's a pretty standard loss calculation. And what we have right now in this world is this kind of purgatory we're in with your insurance carriers about, is this going to be covered or not? Because, there's a feeling, that even though there's usually an exclusion that's included in your insurance policies, that there's some reasonable amount that insurance probably still needs to cover. They did this with cybersecurity claims 5-10 years ago when those started happening, and they weren't covered because nobody kind of knew what cybercrime was. And it's called silent cyber because the insurance policy didn't cover that situation because they didn't really know or expect it to come up. But a reasonable person would probably have expected it to be covered when you have a full, insurance policy in place. So it was kind of unforeseeable. So I'm talking with a lot of different facilities all over the country about whether or not they plan to do a claim. And, with COVID-19, I am sure that you all are doing diligent efforts to keep track of all the extra expenses you have for treating patients with COVID-19, because there's additional reimbursements from the government and things like that. But what I want you to start thinking about is money that you've lost from the whole pandemic happening, right? The elective surgeries that went away or whatever that looked like for your facility, and deciding whether or not, there could be an insurance claim for that. With extra expenses for patients, I think that probably the industry-wide, everybody was really on top of doing that. But there's other extra expenses that would typically be an insurance loss, extra expenses that had it not been for this pandemic, you wouldn't have spent that. And I'm not talking about just patient care expenses. I'm talking about, if you were able to move your billers home and you had to buy them extra monitors or different laptops if they use desktops, different things that were expended in order to keep your hospital running during this pandemic. That is something that we are encouraging people to track or to set up a new general ledger code for, and whatever expenses those were. And so That's above and beyond patient care. If you had to outsource something because with COVID-19, you couldn't, you know, if you had, you know, chemo going on and you couldn't, for whatever reason, did you outsource? Did they go someplace else? You get a bill for that? Whatever it is that you got further because of COVID-19, that's not a direct patient care expense, it's a service fee, that may be something that's worth tracking. And so I've listed some extra expenses down here that I've talked about, you know, with the different healthcare agencies and industries that I've been working with, any temporary equipment or services, that type of thing. If you want to flip to the next screen. And it all gets a little muddy because there's the CARES Act that came, and I'm sure that you all have received a lot of money. It just starts showing up, tranche 1, tranche 2. I've worked with some entities that just keep getting money and they're just trying to make sure, should I keep this money? And so when you're thinking about whether you have a claimable insurance loss, you kind of have to take a look at it this way, right? You have your projected revenue. So we do a lot with projected revenue kind of based off of the last few years' growth for the specific months that have been affected. And so we're talking pretty much into February or pretty much March, April, May, June. You know, if you were growing your revenue or if it was flat for the last few years for February, March, April, May, June. And so we kind of use that to build up what we project the overall revenue. If everything was operating the way it had been, what that looks like. And then you take away what your actual revenue was, and that's the lost revenue. And this is what the government had attempted to make up for you with the CARES Act, is lost revenue from having to shut things down. And interestingly, they pushed this out so fast, and I'm sure you all have thought through this a little bit, but if you all had, you know, sections that you had to furlough people of or weren't running and you didn't have a bunch of expenses because it wasn't operating, they replaced your revenue. And then you didn't have any expenses against it. And so a lot of people are making out pretty darn well right now because they got the revenue. They didn't get the net income at the bottom reimbursed, and they didn't have all those expenses between revenue and the net income. So because of furloughs or layoffs and things like that. So the CARES Act actually, in some instances, is getting people much better off than they would have been without that. But they can't go back and change that, right? They can't go back and say, oh, we meant this to be a net. They said it was for your lost revenue, so you get to keep it as lost revenue. But if you had projected revenue and the CARES Act doesn't cover all of that revenue loss, then it's worth thinking about a business interruption claim. You know, FEMA is way down there at the bottom as kind of a last resort. And the thing about wanting FEMA funds is FEMA's probably not going to want to give you anything until you've tried to get it from your insurance agents. And you may get a denial because of an that you have, and then you can ask FEMA for it. But you have to start by trying, I would think, to get it from an insurance carrier before you go to FEMA. So if you're in a position where that CARES Act did not make you whole, even with, you know, them giving you your lost revenue, then this is kind of what the calculation looks like. Then you take away the projected expenses, you add back the lost expenses, less extra expenses, those extra expenses we've talked about that you know, that you incurred that you wouldn't normally have incurred. You want to claim those separately to get your lost income. Now, insurance policies, of course, have usually waiting periods and deductibles, and maybe both, maybe one or the other. And then you have your kind of gross earnings loss. And then when you add those extra expenses that are not normal expenses to get your time element loss. And so that is kind of the calculation for business interruption loss. So when we're doing this for clients, we're looking at, we have to make sure that the CARES Act didn't make them whole. And a lot of them that I'm working with, it did. And so that's kind of the first litmus test to if you need to consider this, is did your projected revenue less your actual revenue, did that loss get made up by the CARES Act? And I'm sure you're thinking about that or tracking that for the purposes of if they come back and they say, was your lost revenue really this amount? You want to make sure that it is, before you have to give the money back. So you don't have to give the money back. But then business interruption takes into consideration the saved expenses where the CARES Act hasn't. So if you furloughed a lot of people, but you still got the revenue that they would have produced, you have a lot of saved expenses. And so that may make up for the rest that falls down below. So think about that. But be thinking about this in this way when you're thinking, do I need to file a business interruption? Or if we're in a position where we need to get to FEMA, go down and apply with FEMA, they're going to probably want, as my opinion, probably want you to have gotten to them after you tried to get business interruption. Go ahead and flip to the last screen with the last few moments we have together. And I'm happy to answer any questions that you all have. But this is the 20,000, 80,000, 100,000 foot overview of what to do is to access the policy and make sure they're all of it. And a lot of times we kind of skip to the good meat of our insurance policy, but you kind of need to look at all of it. And if you think that you do have a business interruption claim, you have to first put your insurance company on notice. A lot of times they initially say, oh, we have the exclusion for virus and bacteria, so you don't have a claim, but we say just to go ahead and start tracking this anyways, just in case. It's being litigated all over the country because there's an expectation of coverage. With that virus and bacteria clause, came in insurance policies after H1N1 and SARS. It was not meant to be for a pandemic where the government is telling you to shut stuff down, right? And so it's being litigated. State legislatures are putting bills through to try to make it cover, to exclude the exclusion. And there's all sorts of different things happening right now where we're going to figure this out. But if you don't put your insurance company on notice, when you get down the line where you have a claim, you have to have it done it in so long to file a claim. And then tracking your extra expenses. I have confidence that you all are tracking extra expenses for your patients that you're serving or potential patients or potential COVID cases. But with those extra expenses of things that you've had to do just in a pandemic to keep things going, those are extra COVID expenses for a business interruption claim. And you all know your business, you know your hospital, you know when revenues started chunking down and how much. And so as much contemporaneous notes you could put around the recognition of lost revenue, the better. We're sitting here in July. I wish I could have given this information to you in March, but as much as you could go back, you don't want a year from now trying to recall everything that you wish you would have made contemporaneous notes on. So we're not too far away from it. I know we're all overwhelmed, but as much as you can do that, if you think you might have a BI claim, I would do that. And tracked saved expenses. That's the one thing that a lot of the healthcare providers I've talked to haven't thought about doing is those saved expenses. If you're furloughed people, you still have benefit expense, but you don't have, the wages, and those offset loss. And so be thinking about all the expenses that you normally have that you've been able to save and start tracking those and think about those. So that's the bulk of my thoughts on this. And I think my contact information, for the sake of time, we may not have to have a lot of time for questions, but I'd be happy to answer any questions that you all have.
Thank you, Julie. Appreciate that. And we'll just kind of keep an eye on the chat box there to see what comes in. But, I think it's safe to say that the business interruption claims follow the same model as the health insurance claims, and that is deny, 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 everything. So let's go ahead and turn over to Derek Pierce to talk about the Medicaid, CHIP, and the safety net hospitals. Derek?
Thanks, Eric. And as Eric mentioned at the top, I am in our Little Rock office, but I grew up in Pine Bluff, so I'm very familiar with the challenges facing Delta communities and hospitals, and appreciate the opportunity to help them better navigate the complex healthcare environment whenever I can. And today we'll take a little bit deeper dive into the CARES Act funding that Julia alluded to and talk specifically about some of the more recently announced distributions as well as some of the changing guidance. But just quick bit of context, while we've seen margins deteriorate over time, the story of hospital finance, especially in the rural areas, is not one of drastic change, but the response to the coronavirus and the provider relief funds has certainly changed that. We've seen hospitals' balance sheets altered drastically overnight. And as more and more of these distributions have been announced, the questions that we've been getting are more, how can we justify these funds rather than am I going to be made whole or how am I going to survive with volume drops? But $3+ million, it far exceeds a lot of hospitals' identified COVID costs and lost revenue. And another thing that really complicates this is the ever-changing nature of the guidance that has been made available relating to the provider relief funds. And we'll get into that in a couple of slides. But first, we'll jump into the more recently announced distribution. So if we can go to the next slide. The first one that we'll go over is the Medicaid and CHIP distribution. This was announced last month. And if we think back to the original general distribution, that was made to Medicare providers. And there are a number of healthcare providers that aren't enrolled in the Medicare program. So this separate distribution was set up for them. It's a $15 billion distribution. And since the federal government primarily gets information from healthcare providers through their participation in the Medicare program, they had to set up a separate portal to gather the information needed to develop the distribution methodology and allocation. They have pushed the deadline to submit an application through this enhanced portal back to August 3rd. It provides these non-Medicare healthcare providers at least 2% of their net revenue. I think most people on this call probably won't participate in that because most hospitals do participate in Medicare. So we'll go to the next slide. The safety net hospitals have seen two distributions. This first one was a $10 billion distribution based on three criteria that are located in the cost report. They had to have a DISH percentage of 20.2, which eliminates critical access hospitals who don't receive DISH payments. They had to have uncompensated care of $25,000 or more per bed, and profitability of 3% or less on their most recently filed cost report. That led to about 760 hospitals receiving payments of between 5 and 50 million. But there were a lot of hospitals that are clearly safety net hospitals that were excluded from this distribution. So CMS quickly realized this and came up with the second round, which is the next slide, a smaller $3 billion distribution. And instead of looking at profitability in 1 year, they looked at it over a 5-year period and averaged it, because there were a number of hospitals that for their most recently filed cost report for a number of reasons had more than a 3% profitability. That really wasn't an indication of their long-term profitability. So they looked over a larger period and took an average and sent that, announced that distribution earlier this month, and that went to about 215 hospitals. The last recent distribution that we'll talk about is on the next slide, and that's the second round of the high impact distribution. There was an earlier one in April or May, and this one came out last month. It's a $10 billion distribution, and it goes to hospitals that have admission counts of COVID cases of over 160 in that date range provided. It provides $50,000 per eligible admission, and over 1,000 hospitals received those payments. So those are the recently announced distributions. There is still a significant amount of money still to be distributed from the Provider Relief Fund, and who knows what will be in the next relief bill, but there will still be funds distributed.
Hey, Tracy, quick question for you. So now that this thing is extended and there's kind of the second wave happening right now, any indication or opinion from your end in terms of, if we have a high admission count, but it didn't happen until mid-July, do we think we've got a shot at that maybe down the road?
Yes, the guidance has started to acknowledge that this may be a protracted affair into 2021 even. So I do anticipate that that this will not be the last opportunity for hospitals that have more recently or have yet to see the surge, but will to get some additional funding. And we'll see it in the guidance that begins on the next slide, glimpses of that. So we can go to the next slide. The guidance has come in generally two forms. First is the terms and conditions that have been released with each distribution, which have been fairly boilerplate and have included, the requirement that the funds be used to cover COVID-related costs and lost revenue. And they also mentioned there would be a quarterly reporting requirement for those receiving over $150,000. The second way guidance has been provided is through the FAQs that are out on HHS's website. And it gets updated pretty regularly. So you really got to go out there frequently to stay on top of it. But some of the more recent FAQs that have put out there that have provided some interesting information, summarized here, they have clarified that you will have through the end of the emergency declaration to accumulate costs and lost revenue. And that, who knows when that will be. The targeted distributions, if you are a system and have a rural hospital that receives the rural targeted distribution, that can't be redistributed within the system. Those targeted distributions are different from the general distributions, and if the rural hospital can't justify all of it, the remainder cannot be transferred up to the parent. Another FAQ that came out was that if in any one year a provider uses or attributes $750,000 of provider relief funds, they will be subject to a single audit requirement, which may be new for a lot of hospitals. But that's an audit of the compliance to the restrictions provided in the terms and conditions. And kind of more interesting is this last one, and potentially significant. Last month they added an FAQ that said lost revenue can be used to cover any cost that the lost revenue would have otherwise covered. And that was the first time they'd really potentially qualified what lost revenue meant and tied in cost to it. And kind of the logical extension of that provision is that if you have to have an identified cost to attribute lost revenue to, is that a prohibition on using the lost revenue to restore a profit? So I think they'll have to clarify that, and we do expect guidance to be coming out middle of next month on really what type of limitations there are going to be. So the next slide talks about those reporting requirements. There was a notice posted a couple of days ago that said you don't have to do that initial quarterly reporting. That was included in the terms and conditions. There will be one annual report for calendar 2020 that will be due 45 days after the end of the year or middle of February. It does envision that some hospitals will continue to have COVID-related costs and lost revenue into 21 and provides for a subsequent reporting if that's the case. And as I mentioned, the detailed instructions for this are due out by August 17th. So that is the extent of my slide deck, but we'll happy to field any questions that there may be.
Thank you, Derek. Appreciate that again for folks on the line. If there's any questions right now, feel free. If not, put those in your in your chat box. We've got about 10, 12 minutes here, so I want to pivot to cost report implications and have Steve from our Houston office come on and talk about this.
Helps if I unmute myself. Thanks, Eric. Next slide, please. So now, as we cover, through this presentation, a lot of our hospital clients have received a lot of different funds, and we're going to be getting close, especially for the June 30s. We'll be preparing those cost reports, in the October, November timeframe, and there's going to be cost report implications for a lot of these funds. So I'm just going to kind of touch briefly on, the main ones. A lot of our hospitals requested accelerated payments. Those are going to be treated just like, any type of claim payment that you would have received. Even though you received that money in advance, it'll be applied to the fiscal year where the claims are filed. The provider relief funds, WPS has made the statement that those are grant funds, and according to the provider reimbursement manual and the regulations, grant revenue does not need to be offset against costs. Like I said, CMS has not put out anything official on that, but that's pretty much under the assumption that the relief funds are grant revenue that will not have to be offset against cost on the cost reports. The PPP loan forgiveness, however, this one, WPS came out just, I think, yesterday to one of the hospital associations and said that it's CMS's position that the PPP loan forgiveness amount does need to be offset against the costs. This will have a big impact on, for critical access hospitals that receive the PPP loans. I do know that the NRHA is lobbying against that and trying to get CMS to change their position. They're also, again, trying to maybe get something fixed from a legislative impact so that the loan forgiveness amount does not need to be offset against costs. But again, typically, if you receive any other type of grant funds for COVID-related costs, grant revenue does not need to be offset on the cost report. Next slide, please. So for critical access hospitals, I just kind of listed, what factors impact their Medicare reimbursement settlement. And really for critical access hospitals, there are a lot of variables that will determine what the hospital gets reimbursed and what their settlement is. We've got expenses, we've got volume, payer mix, reimbursement rates. From an expense perspective, a lot of our critical access hospitals have incurred an increase in expenses. They've seen supply expenses, go through the roof. They've had to hire, additional staffing, overtime, contract labor to care for the patients. From a volume perspective, early in March, when we had the prohibition against elective procedures, we saw a lot of the volumes decrease pretty significantly in our critical access hospitals. So patient days, outpatient visits went down. I'm now seeing a few of my critical access hospital clients that have had an increase in COVID-related patients. So they're seeing volume kind of go back up like a lot of the urban hospitals that are seeing in the outbreaks. So you just look at, let's just say, expenses go up, volume goes down, that increases from an inpatient, a swing bed, the cost per day amount. Payer mix, what is your payer mix doing? Medicare, from a reimbursement perspective, Medicare is always going to pay its share of the cost. If your Medicare mix is going down, where your elderly patients, 65 and older, are not coming into the hospital as much as the younger patients are, that's going to reduce your payer mix, your Medicare mix, and reduce the amount that Medicare is going to reimburse out of the total cost. Then what are you getting paid on an interim basis? We all know that you're getting paid based upon your prior year's cost report. And this year doesn't really probably reflect what the prior year does as far as reimbursement rates. So there are a lot of moving parts for critical access hospitals as far as expenses, volume, payer mix, what they're getting paid. I think it's really important to prepare an interim cost report or do an interim cost report settlement We have a model that you can run things through to see where your settlement is, at any period in time. I think it's important for them to understand, so that they're not getting a big surprise, whether it's a payable or a receivable for next year's cost report. So I think, that's kind of my suggestion. Also, what is the impact if CMS does hold their position on offsetting the loan forgiveness amount? So I think for critical access hospitals, it's extremely important to understand all of the moving parts and how it impacts their reimbursement. Next slide, please. For the PPS hospitals out there, especially the rural sole community hospitals and Medicare dependent hospitals, there's an opportunity to receive a volume decrease payment adjustment. This is an add-on or payment that you can request if your total inpatient discharges decreased by more than 5%. This can be a significant amount. So that is an opportunity for hospitals that have seen a decrease from year to year. They will be reviewed by the MAC. There's a formula for calculating that amount, but that is a good opportunity for our sole community hospital and Medicare dependent hospitals. For the rural hospitals that are receiving Medicare DSH payments, the uncompensated care payments for that hospital is determined on an annual basis based on the federal fiscal year. There could be a potential receivable on your cost report. Again, that they determine an amount and divide it by the number of average claims. So if your Medicare claims have decreased compared to the prior year, you will potentially have a big receivable from Medicare DSH uncompensated care. Medicare bad debt reimbursement, again, this is one, where we really we don't know the full impact, but you may have an increase in bad debt due to changes in the economic circumstances for a lot of these beneficiaries. So, that's something that, again, too, should be maintaining a log, seeing what reimbursement opportunities there are from a Medicare bad debt perspective. There's going to be a lot of future implications, down the road on this is for the PPS hospital. One of them is the wage index. There's a lag in, setting the wage index values, but you can see, the wage index is a budget neutral process. So if one CBSA increases, another one's going to have to decrease. What we've seen is in New York and Chicago, where we've seen, kind of these breakouts in the COVID, is they've incurred a lot of costs for contract nursing. They've had to pay higher wages. I know, for just an example, in Illinois, there were some nurses that were leaving certain rural areas or other areas to go work in Chicago because they could make, 20 or 25, 50% more than what they were making. So that could shift some of these wage index values. Now, CMS may correct that and smooth some of these out so that some of the rural areas and other CBSAs that don't have these big outbreaks don't see a huge decrease in their wage index, but that is something to consider. Also, for PPS hospital, the cost report itself is used to recalibrate the DRGs and what you get paid. The cost that is in these cost reports is going to be significantly different than it was in the past. Again, Medicare DSH payments, part of that is determined based on your uncompensated care and your bad debt expense, your uninsured charity care and your insured charity care. Those, again, based on economic circumstances throughout the country, there's going to be some where that increases, some where that may stay the same. And then also Medicare DSH SSI ratios. So those are just some of the high level ones for the PPS hospitals. Next slide, please. I did want to touch base, a little bit on the rural hospitals that have rural health clinics. So if you have a rural health clinic and it's provider based, you're a hospital with less than 50 beds, including all the critical access hospitals, you get reimbursed on a cost per visit. There has been an expanded telehealth regulations that have allowed hospitals to provide telehealth a lot easier. This is going to have impact on that cost per visit for your rural health clinic. It could potentially have impact on your rural health clinic productivities. Right now, the productivity limits for rural health clinics for the physicians, they're supposed to have 4,200 visits per FTE. The nurse practitioners and the physician assistants should have 2,100 visits per FTE. Again, with volume changes in the rural health clinic, during the COVID pandemic, there could be times where they weren't as productive as they have been in the past, and that may have upticked a little bit again too as the elective procedures were allowed. But this is something to consider. Also, from a Medicare perspective, you're reimbursed based on cost, and that's really your Medicare visits to total visits. Again, there could be dynamics changing in there where, from a cost reimbursement perspective, that those elderly patients may be doing more telehealth instead of the face-to-face encounter visits. So there's going to be a direct impact on the rural health clinic reimbursement on these expanded telehealth and all the implication and trends in COVID. Now, one thing that has came up that just kind of want you to be aware of, you can file for an exception to the productivity limit. This has kind of been out there for a long time, and it's been kind of rare that the MACs have allowed this. So again, if your physicians are not meeting that kind of face-to-face encounter productivity limit of 4,200 visits per FTE and your mid-levels aren't, you can request an exception to that. The MACs that I've talked to are open to this. They pretty much agreed that yes, we're going to allow these. WPS sent out some communication. They would like this 60 days prior to your fiscal year end to set what that the accepted productivity limit is going to be. So this is something, again, too, really, I think that our hospital clients really need to evaluate is again, what is the COVID impact on the rural health clinics productivity and the Medicare reimbursement, and then file an exception request if needed. Next slide.
Hey, Steve, really appreciate your guidance, and Derek and Julia, Crystal, all of you for commenting. There was one other question that came through, and Derek, if you wouldn't mind to respond to this. So it was a question about your slide on the high impact area round 2, where there was 100, some additional funding coming out for hospitals that had 160 plus COVID patients in that time window. And if that were to be available again, knowing that some of these hospitals are a lot smaller and, maybe they only have 20 patients, but that represents 50% of their volume.
Sure.
I know you can't predict or, how CMS will handle that situation, but any thoughts that you may offer on proration potentially?
Sure. And yes, I'm trying to predict how HHS is going to distribute this money is a dangerous business that I'm not going to try to get into, but I will make 2 points in response to that question. One is that there's a lot of pressure from Congress for HHS to push this money out. And the rural areas tend to kind of punch above their per capita weight class in the Senate. So I think there will be additional avenues for rural hospitals to access a provider relief fund. The next point I would make is that even these high impact distributions are subject to the same terms and conditions. And if you have already received more money than your costs, COVID costs or lost revenues can justify, these aren't considered separately. They would just go into that pot and just make the challenge to justify that harder. So that's just something to keep in mind. But I do anticipate rural hospitals will have more opportunities to participate in the provider relief fund.
Sure. Steve, I know you spend quite a bit of time talking with the NRHA folks and with Larry as well, but is there anything kind of from an advocacy thing that you would recommend that some of these hospitals or their legislators do if they're in a pickle or really feel like they need to voice themselves?
Yeah, we really, again, I think, again, have kind of pushed, on a lot of pushback on the PPP loan forgiveness, especially on what, that impact that would have on the critical access hospital. When you're talking about offsetting that salary amount, You know, that would have a significant impact on the settlement, on interim rates going forward. Like I said, I think that's one of the things that we've been talking to them about, to try and make, you know, again, for CMS to try and change their position on this. I think that's probably, you know, the biggest one. Again, too, like Derek said, you know, there are, you know, these targeted relief funds, you know, have gone to, you know, some of these bigger hospitals. But what about some of these smaller ones, you know, the smaller rurals that, you know, yeah, they've got the rural distribution, but still, you know, are they going to start targeting some of the smaller rural hospitals with some additional funds? Because again, too, I think, you know, a lot of them, you know, it's been pretty impactful for them.
Okay. Well, Kate, I'm going to hand it back over to you. My email's on the screen there. If anybody has any questions for any of our folks, feel free to shoot them to me and I can get you in touch with them. If you want to do a call for a little bit deeper dive and discussion, I'm sure that they'd be happy to try to help you out in any way they can. So, Kate, I'll hand it back to you to close us out.
Great. Thank you so much, Eric, and everyone at BKD. Really wonderful information. I know I was taking tons of notes as you guys were talking through all of that. So I just wanted to say thank you to everybody who joined us today, and a reminder that we have another webinar. It'll be the third one in this 5-part series, same time next Friday, and that one will be focused on operational considerations in this recovery. So with that, we'll close things out. Everybody have a great rest of your Friday and a nice weekend.